Hi everyone! 2 weeks ago I made a video on the 3 ETFs you should consider looking at if you're a beginner investor, and my US audience has requested to make the same video but a US version. So this is 2 ETFs and 1 stock you should look into. We're getting a little risky here. Just the stock part, not the ETF part. This is going to be a very short video of me going through the overview of these ETFs and the stock. Always do your own research. By the way, you guys, I am more of a riskier investor than others. Some people only invest in ETFs, but I buy stocks as well. Just a reminder to my Canadian audience that you can buy these 2 ETFs and 1 stock that I talk about, but you do have to convert your Canadian dollars to US dollars to then buy this ETF and stock. So don't overlook the conversion fees. First ETF is VOO. This is the Vanguard 500 Index Fund ETF. It holds the top 500 companies in the US. Their top 10 holdings are Apple, Microsoft, Amazon, Nvidia, Google, Meta, Tesla, etc. In one of my Instagram videos, I said that you can't go wrong in buying this ETF, and somebody said that I can't be completely sure, which is true. I guess you can never be completely sure, but someone else in the comment brought something up that I couldn't have said better myself, and they said that in order for the S&P 500 to completely go bankrupt, people would have to halt their spending, meaning nobody is spending any money. Of course, the S&P 500 holds major consumer goods companies like Johnson & Johnson, Procter & Gamble, Costco, Walmart, McDonald's, Coca-Cola, and the list goes on. It would mean that people stop using their MasterCards, their Visas, they stop traveling, and they stop using technology. It would be a huge deal if the S&P 500 goes bankrupt. The management expense ratio for VOO is 0.03%, which is next to nothing, so it's really good for building long-term wealth. One more thing to add, VOO's dividend yield is at 1.45% as of January 19th, 2024. That is $1.80 per share, and they pay you quarterly, which means every 3 months, 4 times a year. Next ETF you should consider looking at is VTI. That is the Vanguard Total Stock Market Index Fund ETF. And no, this video is not sponsored by Vanguard. It holds the total US stock market, from small cap to mid cap to large cap companies. People always compare VOO to VTI, and they say that it's pretty redundant to hold both because VTI holds the majority of VOO's companies, obviously. So always know what your risk tolerance is and what you want to put your money in. If you're investing in VOO, you're only investing in the top 500 companies in the US. I think specifically 508 companies, whereas in VTI there are over 3,000 companies in that ETF. I would argue, actually it might not even be an argument, but VTI holds 6 times more stocks than VOO, meaning it's more diversified and can be less riskier. But if you just want to niche down and just focus on the top 500 companies in the US, you can do that as well by investing in VOO. I'm going to insert a chart here on the screen that compares VOO to VTI, and you can see sometimes VTI comes out ahead, sometimes VOO comes out ahead. It does seem though that VOO usually outperforms VTI over a longer period. Management expense ratio for VTI is 0.03%, so the same thing as VOO. VTI's dividend yield is at 1.44% as of January 19th, and they pay you $1 quarterly for every share that you own. Okay, last but not least, this is a stock that I've owned before and that I would buy again, and it's Coca-Cola. I think Coca-Cola is a great company, and I think they will continue to grow years and years ahead. It is the largest beverage company in the world, and they are a Dividend King, meaning that they've been paying and growing their dividends for 50 consecutive years. I find that people's biggest problem with dividend companies is that the company isn't reinvesting their capital, reinvesting their money back into the company. And of course, investors would love for companies to reinvest that money into the company to grow it even more. But Coca-Cola, I was looking at their investor overview presentation, and their 2 biggest priorities is reinvesting capital back into the company and paying out their shareholders. I think Coca-Cola has lots of money to continue innovating and marketing, and I don't think people will stop drinking Coca-Cola or their products anytime soon. Coca-Cola has a great reputation, it's valuable, and you get paid just for holding their stock. Their dividend yield is at 0.08%. They pay you 46 cents USD quarterly. This is a long-term hold company, and I would reinvest my dividends back into the stock and let it compound. This is called a DRIP, Dividend Reinvestment Plan. You get paid in dividends, you reinvest it back into the stock, which in turn gives you more in dividends, and you keep reinvesting it and you let it compound. Warren Buffett receives over $7 million in dividends every year from Coca-Cola. Let me know what you guys think of these 2 ETFs and the stock, and if you already own them. Also, make sure you like and subscribe.